Welcome to Heller-Hurwicz Office Hours, a podcast featuring University of Minnesota affiliated economists and their research. In this special series of the podcast, we're focusing on the policy priorities of the second Trump administration and how research can inform our understanding of a rapidly changing economic environment. Over the last several months, the Trump administration is leveraging federal power and resources to systematically dismantle the nation's tools to address climate change. Among other actions, the president has defunded climate-related research, withdrawn from international agreements to reduce global warming, retracted clean energy initiatives, and doubled down on fossil fuels to meet the nation's growing energy needs. In this conversation, economist Bob Litterman will share his perspective on what these changes could mean for identifying and mitigating climate-related economic and financial risks. Well, it's a real pleasure to talk to you.
Chris, it's my pleasure to be here talking to you.
All right. So, considering the number of anti-climate change initiatives that have been taken by the Trump administration, and I imagine there's probably more to come, how worried are you?
Well, let me try and take a long-run perspective, and in that context,
Please.
yeah, it's been kind of disheartening to see what the Trump administration has tried to do. This is a long-term risk management problem, and the real issue is that we need cooperation globally. It's not a U.S. problem; it's a global problem. And in that context, I would say we weren't making much progress. We weren't making fast enough progress, Chris, before this administration. And what this administration has done is, in some sense, blown up the ossified international framework on many dimensions, but climate is one of them. And by pulling out of the UN, the U.S. has made that avenue look less likely to move forward, and at the same time, it's put a focus on bilateral negotiation of tariffs. And actually, that dimension could be very positive. The Europeans have been leading on establishing what I'll call carbon tariffs. They call it a carbon border adjustment mechanism. But basically what they're saying is if you have high carbon content in your goods, we're going to put a tariff on it. And that's kind of an interesting incentive for countries that are exporting to the EU, because they can now either put a carbon tax domestically and keep the revenues, or they can export to Europe without the domestic incentive to reduce emissions. Then Europe will put that carbon tariff on through the CBAM, and they'll collect the revenues. So there's an incentive then for countries that are exporting to Europe to put on their own domestic pricing. And there are a number of countries that are thinking about that. Japan, Australia, and you could imagine if the U.S. were to put a carbon tariff on, and other countries would, all of a sudden you would have a block of countries that had both carbon taxes and tariffs, and it would be, in every country that's not part of that trading block's incentive to join and to put their own carbon tax on and carbon tariff. And so I'm not saying that's going to happen, but that's just an example of a pathway that no one was thinking about before this administration, and you never know what might happen.
I really like that. I mean, it does sort of give a different perspective on tariff being a beautiful word.
Yeah, it does. And I'm not recommending this path, but I'm just saying, you never know. It might be the way to go. And so, I'm trying to think about those kinds of issues. What can we do to create a globally harmonized set of incentives to reduce emissions? That's what we really need. When I step back from this problem and say, okay, what is the problem right now? And the problem is that we're not transitioning rapidly enough to a low carbon economy. I mean, we've got these targets in terms of 2 degrees Celsius increase in temperature, and we're not on a path to hit those targets. We've got to increase the amount of investment that we're making every year to low carbon capital dramatically. I think it's Bloomberg New Energy Finance estimates that we need to triple the amount of investment we're making. And governments are making investments for sure, but they don't have unlimited, resources. And you've got a lot of NGOs that, philanthropy is making investments. But what you really need is to energize the private sector to make investments in low carbon capital. And there's only one way to do that. And that's to create expectations that you're going to make profits from doing that. That's what causes investments to move in one direction or another, is expected profits. And so underlying this is the problem that investors, entrepreneurs don't expect there to be incentives to reduce emissions in the future. I like to think about this the way the International Monetary Fund does. They have a group of economists there that talk about the subsidies to fossil fuels, and they try to measure those. And they measure those both in terms of the explicit subsidies, the amount of money that governments give to fossil fuel companies, but also the implicit subsidies, and in particular, the fact that we don't price the externalities. That's what economists call it, the damages created by
Yeah.
the emission. And those damages are certainly the impact on global warming, but also just the environmental pollution, the particulates. They cause health damages globally. And the IMF does a good job of trying to add all these up. And the numbers they come up with are just astronomical. The global subsidy for the most recent year, I think, was 2023, was $7 trillion globally for 1 year. And in the US, it was on the order of $700 billion in that 1 year. And you compare that subsidy to what the US government tried to put on the other side of the table, the Inflation Reduction Act. That was, I think it was estimated to be $400 billion over 10 years. So, it's a drop in the bucket relative to the incentives that are generated by governments by ignoring this problem. So what we need to do is we need to create those incentives. We need to create incentives to reduce emissions. And then we also need incentives to pull CO2 out of the atmosphere. We should be paying people that kind of money, to pull CO2 out of the atmosphere. The economists call that the social cost of carbon, the cost. We
Right.
Yeah, and that, it's people joke it's the most important number you've never heard about, but it basically is, how much should we be charging people when they're emitting carbon dioxide in the atmosphere? I've done some work on this myself, and with some colleagues, we came up with a number well over $100 a ton, and that was a number of years ago. More recent studies have actually increased that. The U.S. government, under the Biden administration, estimated that at around $200 a ton. And then you go back and ask yourself, well, what are those incentives today? And it's a very sad picture, Chris, because first of all, globally, the average incentive is in the single digits, maybe as much as you know, a tenth or a hundredth of what it should be. It's tiny, and there's no harmonization. Europe had some very strong incentives back in like 2022. They were or was it 2021, before whenever the Ukraine war started. When the Ukraine war started, of course, then there were all kinds of subsidies to energy in Europe, and so those incentives to reduce emissions have gone down in Europe. The U.S. China, India, Russia, the big emitters have never had strong incentives. And many of the countries around the world, especially in the Middle East, Mexico is an example, have strong government subsidies to fossil fuels. In the Middle East, gasoline and energy, electricity is almost free. And so the implicit price of emissions is actually negative. The government is subsidizing these emissions. It's it's very sad. And so what we need globally harmonized incentives to reduce these emissions. And now what the US is doing today obviously is going completely in the wrong direction. It's pretending this reality doesn't exist. It's probably the worst country right now in terms of being a bad actor. Again, the good news is other countries are moving very quickly. China is amazing, how quickly they've moved in the direction of low carbon. They've been number one in solar, number one in batteries. Over half the new vehicles in China are either electric or hybrid. So, over half new vehicles versus the US, where we've been slowing down.
Slowing down, I know. So what do you've talked to a lot of groups, you've written about this, and, it's probably a famous image, the yellow jackets in France. But, reflecting the protest, hey, there's all these upfront costs for a long-term benefit. I don't wanna bear that upfront cost, which is not an unreasonable reaction by a lot of people. What are you finding that works in convincing people that this is something that we need to we need to address in the short term for this long-term benefit? What works?
Well, y it's a tough problem. It's clear that some things work better than others. The Yellow Jackets is an example where I think France was trying to go too fast. They already had strong incentives in France, as they did throughout Europe at that point in time, and, so they got the pushback. You saw it recently in Canada. Canada's been very good historically about creating these incentives, but when it comes to people and particularly gasoline and filling up at the tank, it's very unpopular. And so I don't have I wish I did have, a magic solution. The problem is getting tougher and tougher, but I would say on the other hand, the public awareness is getting higher and higher. It's coming home to people. You saw the floods in Texas the other day. These extreme weather events are happening more and more often, and they're affecting more and more people. The front line of climate change today is your home insurance. And, there's all kinds of extreme weather hazards. There's wildfires, there's hurricanes, there's riverine flooding, there's droughts. There's just all kinds of hazards, and the insurance companies are they're not going to take that on. They're raising the rates everywhere. So that's causing people to become aware, and I think the awareness is leading to the ability to get the political groundswell that we need. Now, the problem politically is that it's not high on people's agendas. It's never the number one, not never, but for most people, it's not the number one thing that they're thinking about. And so it's been a difficult political problem for sure, not only in this country, but throughout the world.
So how did you land on this risk management perspective thinking about climate change? I mean, I've found it really persuasive because if you're weighing, the risks, sure, why wouldn't you approach it that way? But it's actually not it's not a perspective that I think is probably becoming more common, but it's not that common yet.
No. Well, My undergraduate major was human biology. Somehow I got into, quantitative fields later in life, but I did have that background in biology, and so I've always thought about people as being part of nature, and we respond like other biological species to incentives, and that's just kind of obvious, I think, and so when you think about what has to happen here? Well, we have to create the incentives so that people will respond, and then they will. And when I got to Goldman Sachs and started working on Wall Street, and I was a young quant, they wanted me to help them manage risk. Well, okay, it's risk management is kind of statistics, it's part of economics, but it gets very complicated, I would say, on Wall Street. You start managing risk in portfolios and you start
Right.
balancing risk and return. And so that kind of became my specialty, balancing, measuring risk and return. I worked with Fisher Black on a, famous model that's called the Black Litterman model. And that's exactly what it tries to do. It tries to balance risk and return. So when I retired, and one of my partners said, "Bob, are you interested in the environment?" I sort of thought, well, if I go back to my undergraduate days, I had an interest in the environment, but I haven't really done much with it. But I'll tell you, I said, well, it seems to me that this climate change is a risk management problem, and we're just not measuring and managing the risk appropriately. We're certainly not pricing the risk. And well, my partner said to me, Bob, that's a great insight from an economist. We're not pricing the risk. But let me tell you, the problem is no one knows where to price the risk. And I thought, wait a minute, that can't be true. I'm an economist. I can read the literature. Someone's thought about this. And that is what, kind of got me interested and dragged me in. And I started thinking when I started reading the literature, we've pushed risk pricing a long way on Wall Street. And when I say that, I mean, we worry about things we call beta. Most people
Right.
have no idea what I'm talking about, but risk is not the volatility of an asset. When you're thinking about it from a portfolio perspective, risk is how does it affect the risk of my portfolio? And it could be positively correlated, it could be negative. And so you get these things that take risk, another step in the dimension of understanding it. And so when I started thinking about climate risk, well, they weren't talking about covariances and things like that we worry about on Wall Street. And so I thought, I can probably add to this discussion. And anyway, that's what got me interested in it. That's why I have this risk management perspective. And I will tell you, nothing that I've learned over the, I don't know, 15, 20 years that I've been focused on this, nothing has dissuaded me that it's exactly what it seemed like, a risk management nightmare. We're not managing the risk. And the essence of it is we're not pricing the risk. And rather than no one know where to price it, I mean, the truth of the matter, that's what we were talking about, the social cost of carbon. We've learned that we should be pricing it much higher than we thought. And sometimes people say, oh, there's so much uncertainty. How do you know where to price it? You're just using a model. And all of that is true. But I'll tell you what, when you're a risk manager and you say, well, maybe I should be pricing it here, maybe I should be pricing it here. Where are you gonna price it if you don't know for sure? It's a risk management problem. You gotta err on the end of the high end, not the low end, right? And the high end is even higher. So we have totally screwed this up. We've gotta slam on the brakes. That's what I've been saying for 10 years. The only brake we have are the incentives to reduce emissions. So I would say in that context, what the Trump administration has been doing obviously is moving in the wrong direction, obviously for reasons that have nothing to do with managing climate risk. And and yet, it's a longer term problem, and who knows? Maybe this disruption of the UN process will allow another process to move more quickly. And I hope that that's true. I certainly see positive signs around the world, as I say, in China and other countries. This country is viewed as like some crazy, backward looking, and it's certainly not good for the country. I mean, we all know where the world is going. We're going to clean energy. And so, to tell our country, don't move in that direction is kind of obviously the wrong thing to do. And it's bad for the country. It's bad for the world. But, you never know what might happen. We weren't going in a good direction as it was. And I will tell you that there are other positive signs, I think. Again, what's really important is to change expectations about future pricing of emissions. And, historically, we haven't had very high expectations. People haven't been investing. I don't think those expectations have changed yet, but what I see on the horizon is this CBAM that we talked about from Europe. It requires measuring the carbon content of imports. And there's a lot of movement now to try and better measure that carbon content. Carbon accounting is something that people are starting to focus on. And to me, that's a really important and good sign, because if you're not, even accounting for it, if you're not measuring its flow through the economy, and right now we have some, really old-fashioned, I would say. It's not really accounting at all. We have what we call the GHG protocol, which is kind of a disclosure mechanism for corporates, but it's not carbon accounting. So we've got to move in that direction. We've got to create those incentives. We've got to get blocks of countries that agree to, have incentives to reduce emissions in themselves, and then get the rest of the world to join. So hopefully that will happen soon.
Well, hopefully it would. So I can't let you go without asking about this one thing, and this is, narrowing in on. But there was this initiative by the Environmental Protection Agency to rescind the 2009 endangerment finding, which is the scientific conclusion that greenhouse gases contribute to global warming and harm human health and well-being. Um, what was your reaction when you saw this proposal? I mean, I have a feeling I know what it is, but I have
I
to ask you.
couldn't believe it. I mean, who is this crazy guy who thinks that, this isn't no one really believes that, they all know it's true. It's just that, for whatever reason, they're trying to move in the wrong direction. I don't know.
Where do you think we should put our focus on when it comes to climate change from a risk management perspective?
Well, we've got to price the risk. That's the fundamental problem. We've got to give entrepreneurs, investors incentives to create low carbon capital. And that requires us to create those incentives. And that's by pricing risk. And, where to price it? The answer is much, much, much higher than where we are today. We have to have really strong incentives.
And that's what I think people underestimate. If you say, here's the price, entrepreneurs are incredibly ingenious. Like, I've been doing a lot of reporting with tariffs. And what is so striking is the tariffs really haven't been on that long. And already entrepreneurs that I was just talking to someone in the stereo business, they're no longer, they're now doing directly from China to Canada as opposed to going from China to the US to Canada. Now they've already set that up. They're creating new supply chains within what, 3 months?
Yeah, no, markets are very efficient. People react, that was certainly something that I took away from Wall Street. Is you give just a few basis points of incentive, and people, the capital will flow. You'll manage the risk, you'll take advantage of every opportunity. And that's certainly true in the climate space. And that's why we're moving too slowly to reduce our emissions, because we don't have those incentives in place. And where we do have them, in countries like China, boy, they're moving quickly, and good for them. I wish we were moving as quickly.
Well, thank you very much for your time. Really appreciate it.
All right, thank you.
Bob Litterman He is a founding partner at Kepos, an investment company based in New York. Office Hours is a production of Matriarch Digital Media, hosted by me, Chris Farrell, executive producer, Twilight Dang, producer and editor, Beth Gibbs, music by Bob Bradley. A special thanks to Heller-Hurwicz, Hannah Fairman, and Anna Adamson. Subscribe to Heller-Hurwicz Office Hours to hear about the economic research being done at the University of Minnesota. And to learn more about the research we discussed today, visit hhei at umn.edu. Thanks for listening.